Hey there, welcome back to The Art of Value. This is episode 68, can you believe it? So today I wanted to revisit 100 Baggers, a book by Christopher Meyer. I've done an audio version of this early on, up to number 68, so it was kind of early on. I just want to revisit it because I've had to think about it and I've learned more and would like to talk about it a little bit more. So it's called 100 Bagger Stocks that Return 100 to 1 and How to Find Them. So a 100 Bagger is an investment that returns 100 to 1. And Chris wrote this book after reading another book called 100 to 1 in the Stock Market by Thomas W. Phelps, which is a few decades old, more than a couple of decades old, called 100 to 1 in the Stock Market. A distinguished security analyst tells how to make more of your investment opportunities. So you might be able to tell even by the title that Chris' book's kind of much more readable. It's also got examples up to date of 100 baggers over the last couple of decades. You know, companies like Monster Beverage and Berkshire Hathaway and many other 100 baggers over that time period. But Chris, so he studied 100 baggers of the past and tried to find patterns to tell us how to find them in various ways, because there are some definite patterns there. And since reading it, I've kind of been, analyzing stocks and companies. It's interesting to see how it relates to stock analysis today. So part of the blurb of the book is in 100 Baggers, you'll learn the key characteristics of 100 baggers, and why and the fact that anybody can do this. It's not like you need decades and decades of analysis skills to do it. So it's kind of quite appealing, I think. Even if you never get 100 bagger, this book will help you to turn up key winners and keep you away from losers and sleepy stocks that go nowhere. So 100 bagger is extremely rare. There are always some that are kind of on their way to 100 over time, in any time period. But, 10x, so 100x or even 10x is good, right? So 100 baggers, what is a 100 bagger? Stocks that return $100 for every $1 invested, 10,000 to 1 million, for instance, turning $10,000 into $1 million. They're rare, but you only need to find one in a lifetime. Some investors, like Chuck Akra, I did an episode the other day about his portfolio update from Q1 2022, quarter one, and I think there was about 11 stocks. I think he has. They're pretty concentrated, but he's had more than one. He's had 200 baggers. One of those is American Tower, which puts the like mobile phone towers, and I think it might be Visa's another one. Berkshire Hathaway's another one, as I mentioned. So what are the characteristics and how do you find them? So they're long-term compounding is a key, so you've got to let them run for decades and decades. He studied 100 baggers of the past, said that. So this is the summary that I've put together, and that summarizes the whole book. So it's basically 10 points, doesn't take too long. How do you find 100 baggers? You have to look for them at first. There's no point, you're not going to get an investment that's a 100 bagger unless you actually look for it. So that does take some time. And but there's no rush. Like if you just rush it and you can regret it when it doesn't turn out to be good, and you might have to sell it again, make a mistake. So there's really no rush to it, even though it takes time for them to compound. And you have to have the cash to buy them, of course, when you find them. And number 2 is growth. The good growth is good growth and bad growth. I won't explain that here, but in sales and in earnings per share, he says sales growth and earnings per share rather than short-term EPS, that's earnings per share. So there has to have lots of room to expand, to grow over time, and you have to understand the business as well. That's really key. That's a part of not rushing it. So having lots of room to expand, I'll talk about this later, but smaller capitalizations, like companies worth less than $1 billion. So if you look at, I'll talk about that later. I'll just put a pin in that. Number 3, lower multiples preferred, but it's not a hard rule. So the PE ratio, price to earnings ratio, collapse can kill returns. So if you buy something with like 30 PE and it collapses to 10, that's not going to help. But he says he's found that don't dumpster dive for 100 baggers. Don't pay too little either. You can pay up more for a great business because like 100 baggers grow so fast, so much. You can pay a bit more if the stock price seems a little expensive. That's okay, because as long as the growth is there. But don't miss a chance to acquire great businesses at great prices either. And it's interesting to see the market now. We're in a pretty much a crash in the Nasdaq index. It's nearly 30%, 10%, 20% a bear market. We're at 30%. But the S&P 500, which is the kind of the benchmark for, usually understood to be the benchmark for the whole market, is down around 20. It dipped into 20 the other day, so it's in bear market territory. So one could say it's not a bad time to buy. Warren Buffett's been buying in the first quarter. That's always a good sign from Berkshire Hathaway. So looking for companies with very high returns on capital consistently. That's really important. You can pay a higher price for these companies. So, returns on capital, returns on invested capital, for instance, or returns on capital employed, a bit technical, but if that's, the average is around 15% return for the average company in the S&P, I think. So if some companies have 20, 25% or even higher. If you look at your Google, so I haven't looked at it lately, but I think Google has much higher. So the great companies have high returns on invested capital, which means they're able to reinvest the money that they make to grow more, rather than not knowing what to do with it, not reinvesting well. And a lot of it comes down to management as well, or the business just being so good that it just gushes cash really over time. So Chris says 2 and 3 together are the twin engines of 100 baggers. So remember, 2 and 3 is being low multiples and growth. So getting those together, if you get a low multiple and it expands over time, and growth will give you will really help that investment grow big, not necessarily fast, but sometimes fast. The other one is you can use the PEG ratio. This is a bit technical, but the P ratio divided by the annual earnings per share growth rate. So P less than 1 basically means its earnings are growing faster than the current PE. Peter Lynch also likes this measure. Peter Lynch actually, I believe, coined the phrase bagger. He talked about 10 baggers. Peter Lynch, of course, is one of the best fund managers of all time. Had a 13-year streak of, I can't remember the exact number, but it was nearly 30% compounding annual growth rate. So that compounding over time ends up being a whole lot of money. If earnings grow at 20%, then the P is justified. Then a PE of 20 is justified. So that's how it goes. So PE of 20 can seem quite high if you're looking for bargains, but not too bad if the company's growing at 20%. Charlie Munger said that too. It's better to pay up a little bit, reasonable prices rather than bargain prices, because over time it won't matter. Anything above 1 times could be too expensive. We're talking about the PEG ratio there. The higher the multiple you pay, the higher the earnings growth rate needs to be. Makes sense. So if you're paying a 30 multiple, and there are other multiples too, but we're just talking about P at the moment. So number 4, economic moats or sustainable competitive advantages are necessary. Of course, a moat, that's Warren Buffett, one of the greatest investors of all time, perhaps the greatest. Nearly 20% per year over 57 years, I think it is now. But economic moats or sustainable competitive advantages. So a moat is a sustainable competitive advantage. So if you think of a business like Google, so it has a sustainable competitive advantage in search advertising. I mean, there are other search engines, but Google's become a verb just to Google it. And there are others too. I mean, Amazon has a competitive advantage. I mean, the great companies, the great businesses of all time, you find will have competitive advantages. So the trick is to find them and find them early. So number 5, smaller companies are preferred. Here we go about finding them early. It's unlikely Apple will be a 100-bagger from here. No, when you're talking about $1 trillion company or a $2 trillion company, that's going to be, if it's going to go 100 times from there, that's almost, you could say, pretty much impossible. I mean, they're going to run out of customers and even things to produce that's in their competence range. Apple's talking, I mean, there's rumors about Apple having an electric car yet to be done, but I mean, if that could possibly help, but 100 times, 100x, probably not. But if so the general rule is a market cap should be less than $1 billion. So if you're talking about $1 billion company and that's to $100 billion, there are a few companies, but so generally a lot of companies don't grow to more than 50 billion. I mean, you could say that. So anything up to 5 is, 5, if you're buying like a stock with a company of a market cap of 5 billion and you want 10x, that has to get to 50 billion. And there are quite a few tech companies that are around 50 billion these days, but basically the smaller the better. So the earlier you get in, the better. Is what he's saying here, what the results of the survey were. Another one is owner-operators preferred, which means an owner with a vision and purpose. A founder with skin in the game is much preferred, but it's not required. And he gives the example of Gillette. It wasn't an owner-operator there, so the CEO may not have founded the company. But if you think of companies like Amazon, Jeff Bezos, Apple, Steve Jobs, he's obviously not there anymore. Facebook or Meta now, Zuckerberg. So these companies, and Elon Musk, of course, with Tesla, all these companies had founders with a vision and a purpose, and they owned a fair amount of the company themselves, which helps. That they're going to probably do the best jobs than some hired CEO that's paid, say, $30 million, which is not unusual in America, $30 million a year, and they leave after 3-6 years, whatever. Are they really going to do the best job to grow the company? Perhaps not. Number 7, you need time, at least 5, but more like 20 years. And fight impatience. Use the coffee can approach. So a coffee can approach is back in the old days when they had actual share certificates. Some people who had a coffee can approach would put share certificates in a coffee can, an old coffee can, put it on the shelf, and just not touch it, not even think about it for 10 or 20 years, and come back to it, and there might be a 100-bagger, and there are examples of that. There are anecdote stories of that happening. I heard one the other day of somebody whose grandma had shares of Microsoft early on and left them to him in her will. And it was, obviously that worked out pretty well, and she really didn't really much care about it. She just sort of kept it in the coffee can or wherever, the metaphorical coffee can, and it worked out well for her grandchildren. A portion of your portfolio for 10 years in a coffee can. So you don't have to do it for all of the portfolio, but some of it. And you need a good filter. Number 8, we're up to number 8. The financial media is bad. Stocks move up and down. Even 100 baggers can move down a lot, 20% in a month or more, but the business itself moves more slowly and steadily. The level of the stock market isn't really relevant. So this goes to the coffee can approach. Don't get distracted by the tickers and flicking lights and the ups and downs of the market. And it's really relevant to now when some of these emerging tech stocks, some of them with not huge market caps, are down 80%. And Amazon itself, during the dot-com bubble crash, a lot of companies didn't just, went under, bankrupt, but the ones that did survive did well, like Amazon. It crashed about 95% of the dot-com bubble. So a lot of people would have been really disillusioned by that. But if you'd had the coffee can approach and just bought Amazon after the crash, even, like it's $6 or something, and today, of course, it's over $2,000. I think it's gone down actually. We're down 40% at the moment. So again, is that a good time to buy? But it is a huge company now. So, 100 baggers the point here is that, they can be hugely volatile. Pretty much every company goes down 50% at one point, and people can get scared out and sell if it, but to best just you have to handle the volatility. Number 9, luck helps. Luck is the best superpower. It says that Apple invented the iPhone and it took off, and not many people actually saw that coming. Well, they did when it was coming up to it. People were kind of waiting for it, but there were already rumors of it, and it worked out as a big success. I remember there were people lined up around the block where I was in Australia, in Sydney at the time. There's an Apple store there. People were camping out to get iPhones. I mean, that was a sure sign that they were onto something. But if you'd hold Apple before that, they nearly went bankrupt. Steve Jobs left, he came back. I mean, these are the volatility, but there's luck involved. There's a bit of luck involved, but luck helps. Nothing wrong with a bit of luck. The best superpower. Number 10, be a reluctant seller. Sell almost never if the stock has been chosen right in the first place. That's about not rushing it. Choose right first time. And I'd say, also 10's a good number to have because everybody's going to make mistakes. Sell only when it's clear you've made a mistake on the initial research. Everyone makes mistakes. In fact, Peter Lynch, said about, even the greatest investors are only right about 60% of the time. 70 is just absolutely amazing. And 50 is even fine. You'll still do well if it's 50% of the time. So, everybody makes mistakes. Don't take action for non-investment reasons. Easy to sell for something to do with not the fundamentals of the company. Sometimes you'll have a nasty loss on any position, and you've got to be able to handle that. Sometimes it has been a mistake. So that's the 10. The summary of the 100 baggers. Hope you've enjoyed that. This will be on YouTube, and this video will be on YouTube and Spotify video now. That Spotify allows video, which is great. In fact, this is going much better on Spotify than it is on YouTube at the moment, partly because I started audio on Spotify, the episodes up to number 68, so I think it was around 30 or more were on audio, and Apple. So it's Spotify and YouTube for video, and the other platforms, Apple, Google, wherever you get your podcasts, as audio. And also join me on Twitter at The Art of Value for discussions and any questions or discussions we have about investing. All right, see you next time.